Are you tired of struggling to make sense of the stock market? Discover the power of a diversified investment portfolio and learn how to build a portfolio to help you achieve financial independence. Number 1. Start with a clear understanding of your investment goals. When it comes to building a diversified investment portfolio, there's one thing you really can't afford to overlook: understanding your investment goals. It might sound like common sense, but trust me, it's absolutely crucial. Let me explain why. Picture this: you're standing in front of a massive puzzle with hundreds of pieces scattered all around you. Where do you even begin? Well, that's exactly how it feels when you dive into the world of investments without a clear understanding of what you're aiming for. See, each person has their own unique set of financial aspirations. Maybe you're dreaming of a cozy retirement, a beautiful house to call your own, or providing your children with the best education money can buy. Whatever it is, your investment goals serve as your North Star, guiding you through the tumultuous waters of decision-making. By identifying your investment goals up front, you can make smarter choices when it comes to your portfolio. For instance, let's say you're in it for the long haul, looking to secure a comfortable retirement. In that case, you might be willing to take on a bit more risk, gambling on higher returns down the line. After all, time is on your side, and you can afford to weather the storms of the market. On the flip side, if you're saving up for a short-term goal, like that down payment on a house you've been eyeing, caution might be the name of the game. Instead of swinging for the fences, you'd likely want to focus on more conservative investments. These provide stability and ensure that your hard-earned money is preserved, ready to be put towards your dream home when the time comes. But it's not just about aligning your risk tolerance with your goals. Understanding your investment objectives also helps you stay on track and avoid common pitfalls. It's easy to get swayed by market trends or succumb to the fear of missing out on the latest investment fad. But when you have a clear understanding of what you're working towards, you can stay focused and disciplined. You'll be less likely to make impulsive decisions that could derail your long-term plans. So before you dive headfirst into the world of investments, take a step back and ask yourself, what am I trying to achieve? What are my long-term objectives? Armed with that knowledge, you'll be well equipped to navigate the complex maze of investment options and build a portfolio that truly reflects your aspirations. Number 2. Consider your risk tolerance. There's this crucial aspect that often gets overlooked, but it's actually quite simple once you understand it. It's called risk tolerance, and it plays a significant role in your investment journey. Now, risk tolerance is essentially the amount of risk you're comfortable taking on in pursuit of higher returns. It's influenced by a few factors, such as your age, income, and investment goals. Let me give you a couple of examples to paint a clearer picture. Imagine you're a young investor, just starting out in the world of investments. You've got time on your side, and you can afford to ride out the ups and downs of the market. In that case, you might be more open to taking on a bit more risk in your portfolio. After all, you have the luxury of waiting for the markets to bounce back, and you're eager to maximize your potential returns. On the other hand, picture yourself nearing retirement, with your sights set on a more stable investment strategy. At this stage, you're not as interested in high-risk, high-reward opportunities. Instead, you want to focus on more conservative investments that can provide a steady income and protect your hard-earned savings. Understanding your risk tolerance is crucial because it helps you find the right balance of assets for your portfolio. By knowing how much risk you're willing to take, you can make informed decisions that align with your financial goals and bring you peace of mind. Now, there are a few ways to assess your risk tolerance. Some folks like to take quizzes or questionnaires that gauge their comfort level with risk. It's a handy tool that gives you insights into your own preferences. Others prefer to work with a financial advisor who can help them develop a customized investment strategy tailored to their risk tolerance and goals. No matter which path you choose, the key is to have a clear understanding of your risk tolerance before diving headfirst into the world of investing. By building a diversified portfolio that aligns with your risk tolerance and investment goals, you can set yourself up for long-term financial success while enjoying the journey along the way. So remember to take the time to assess your risk tolerance and make decisions that make sense for you. With a well-balanced portfolio and a solid understanding of your own comfort level, you'll be on your way to reaching your financial dreams. Number 3. Diversify across asset classes. Now, I know what you might be thinking. Why bother with diversification when you could just put all your money into one investment and hope for the best? Well, here's the thing. Investing isn't a game of chance. It's about making smart choices and managing your risk. And that is where diversification comes into play. So what is diversification? It's all about spreading your money across different types of assets. Think of it as not putting all your eggs in one basket. By diversifying, you can reduce your overall risk and potentially improve your returns. You see, different types of assets behave differently under different market conditions. Stocks, for example, tend to perform well during a bull market when the economy is thriving. On the other hand, bonds provide more stability during a recession or when the stock market is going through a rough patch. By investing in a mix of assets, you can balance out the ups and downs and minimize your exposure to any one market or industry. But here's the real magic of diversification. It can help you navigate market volatility and economic downturns. If one asset class takes a hit, you've got other assets to fall back on. It's like having a financial safety net that cushions the impact of any bumps on the road. And let's face it, the market can be a roller coaster ride at times, so having that stability can set yourself up for long-term financial success. Now keep in mind that diversification isn't a one-size-fits-all strategy. The right mix of assets for your portfolio depends on your individual goals, risk tolerance, and investment timeline. It's important to take the time to assess your own situation and make informed decisions. Number 4. Choose low-cost investments. So here's the deal. You want to choose investments with low costs whenever you can. And luckily for you, there are a couple of options that fit the bill. Let's start with index funds. These are mutual funds that track specific stock market indices like the S&P 500. The beauty of index funds is that they don't require active management, which means they tend to have lower fees and expenses compared to other mutual funds. Another option to consider is exchange-traded funds, or ETFs for short. These little gems also track specific market indices, but there's a twist. They trade like stocks on an exchange. This makes them a more flexible choice for investors who want to buy and sell quickly. And you guessed it, ETFs also tend to have lower fees and expenses compared to actively managed mutual funds. By opting for low-cost investments like index funds and ETFs, you get to keep more of your hard-earned money working for you. Plus, these investments offer broad exposure to the market, so you can still achieve that much-needed diversification without feeling the pinch of high fees and expenses. Number 5. Monitor and rebalance your portfolio regularly. One fundamental aspect of managing your portfolio is regular monitoring and rebalancing. You see, the value of different investments in your portfolio can change over time, which may cause your asset allocation to deviate from its original intended mix. Let me give you an example. If stocks have performed exceptionally well over a certain period, they may now represent a larger portion of your portfolio than you initially intended. By monitoring your portfolio on a regular basis and rebalancing when necessary, you can bring your asset allocation back in line with your desired mix. This is crucial because it helps you avoid taking on too much risk or missing out on potential returns. Additionally, rebalancing forces you to sell high and buy low, which is a fundamental principle of successful investing. Now, you might be wondering, how often should you rebalance? Well, it depends on your specific situation and goals. But as a general rule of thumb, rebalancing at least once a year is good practice. However, if you experience significant market movements or there are changes in your personal circumstances, such as a job change or retirement, you should rebalance more frequently to ensure your portfolio remains aligned with your objectives. Remember, building a diversified investment portfolio is one of the most important steps you can take toward achieving your financial success. By understanding your investment goals, risk tolerance, and the importance of diversification, you can create a balanced portfolio. We hope you've enjoyed this video and found it helpful. If you have any questions or comments, please leave them below in the comment section. And remember to give us a thumbs up and subscribe to the channel for more informative investing and personal finance strategies. Thank you for watching.